Continuation of the business finance. Today we are going to see in brief of traditional finance in the business finance concept. Business finance is nothing but it is an area of finance that deals with sources of funding and the management of assets and liabilities of a company. It is an integral part of any business regardless of a size and or industry. In that traditional finance concept of finance is focused on maximizing profits and shareholders' wealth within a static and predictable movement, whereas modern finance takes a more dynamic and holistic approach, considering various stakeholders and evolving their landscape. The approach in the traditional finance is a transaction centric, where the approach of modern finance will encourage in user acceptance and adoption, innovative and embedded collaboration with mobile accessibility. The traditional finance data focus on data gathering only. The data model used in the traditional approach is a data matrix and disconnected data. The reporting on traditional finance will comes as a batch on batch. The budgeting of the traditional finance is a manual spreadsheet. Forecasting in the business finance of traditional way is a limited tool and the capabilities. The system approaches is on only on the premises. The traditional finance function is nothing but it is followed in a finance function for a past decades centered around paper-based manual transactions and processing. It is arranged the procurement of new financing, accounted for various forms of operating capital, and contributed to handling the legal matters. Broadly speaking, finance, tax, treasury, where are the three core functions in the traditional finance functions. It is depend upon the size of the firm and the operating model in a place. The finance function may have held additional responsibilities, including insurance, investments, and risk management. Its purpose in the organization was to accurately record and report on the key financial data, which causes such as follows as operating cash flow, which is and the second one is gross profit margin, burn rate, cycle time, sales growth, debt to equity ratio, return on assets, inventory turnover, payroll headcount ratio, and many more comes under the uh, traditional finance in the business finance, which is the data often lacked dimensionally and wasn't scalable, accessible, or in some cases meaningful enough to make substantive decision about the future. Finance was successful at back office accounting, but its ability to innovate on behalf of the business was wholly constrained. The business a traditional business finance or a breaking down silos between the departments and between data architects. In some cases this means implementing enterprise management tool that the other applications are bolted onto, or it's a platform that outright replaces legacy software and processes. A energized focus on data integrity, data visibility, and data insights has meant all business systems must be able to talk to each other in same language. With finance data, it can automatically be stored, archived, and synchronized with other data streams for greater analysis. For instance, the operational data like employee skill gaps, talent acquisition, and satisfaction rating can be overlaid with budget and actuals from the financial management team. The volume and velocity went probabilically. Not all firms had the resources and software through the data which the traditional finance function takes places. It is devolved into profit maximization, and it is always focused on a short-term focuses, limited stakeholder considerations, and static environment. Finance was able to deliver insights faster thanks to an arsenal of technology which gives an big space in the traditional finance system. But the traditional in finance system is overrated by the modern concept of finance, which gives an relief for the persons working in a